In every economic crisis, the same pattern repeats itself. Millions lose their homes, small businesses collapse, workers drown in debt, while at the same moment a tiny group quietly acquires more land, companies, and assets at fractions of their previous prices. This isn't coincidence. It's the result of movements engineered by an elite class representing less than 1% of the population, yet controlling much of the world's money flow and financial decision making. They can inflate asset prices through loose credit, cheap money, and market optimism, then reverse everything by tightening interest rates and restricting liquidity, causing markets to crash and forcing ordinary people to sell in desperation. What appears to be natural market behavior is often the outcome of coordinated actions. When housing prices soar, they stay out. When prices collapse, they buy aggressively. You see property prices skyrocket, bubbles forming and bursting overnight, entire economies shifting from growth to recession in months, but you don't see the hands guiding these movements. And the defining question that begins this entire story is who is truly holding the shears in this global sheep-shearing cycle that so many people don't even realize they're caught in. When people talk about the elite, most imagine individuals who simply want more money, but cash is only the surface. What they truly want are the kinds of assets that generate long-term power. Land, real estate, companies, resources, energy, and most importantly, your future labor. Money can lose value, governments can print more, but land, corporations, and human time cannot be created endlessly. That's why in every economic cycle, the same pattern appears. When asset prices rise, they quietly sell. When the market collapses, they are the first to buy. And in both directions, ordinary people pay the cost. What they want from you isn't the money you have today, but the next 10, 20, or 30 years you'll spend working to repay debt, mortgages, car loans, credit cards, interest. When you're in debt, you lose more than money, you lose freedom, choices, and the ability to pause. And this is exactly why they never want you to accumulate enough capital to escape the cycle. A person with capital is hard to control. But someone who must go to work tomorrow because of today's bills is someone they can control for a lifetime. To understand how the elite operate this sheep-shearing cycle, you have to start with a small difference in mindset that create two completely different lives. For ordinary people, the goal is to have stable monthly income. For the elite, cash flow is only a temporary bridge to owning real assets. An employee feels secure when they see their salary arrive in their account every month. They treat that flow of money as the reward and the safety net. But for those at the top, cash is like water flowing through their hands. It appears, disappears, loses value, gets taxed, and is eroded by inflation. The only thing they truly care about keeping is not the number on the screen, but anything that can generate recurring income for years. Land, factories, companies, infrastructure, resources, lending power, and the right to charge interest. So while most people spend their lives trying to increase what they earn, the elite use what they earn to buy everything that will make others work for them in the future. They are not obsessed with how much did I make this month. They are obsessed with how many assets do I own that will make other people pay me month after month. That's the mental gap that makes the game unfair from the very beginning. Ordinary people spend their entire lives thinking, how do I earn enough? While the elite spend theirs thinking, how do I own what others must keep working for? In every financial cycle, you see money being pumped out, flowing through the hands of the public during boom times, and then flowing back into the system through debt, interest, taxes, and crisis. What remains after each cycle is not the cash, it is the ownership that has quietly changed hands. Stocks, bonds, real estate, farmland, infrastructure, key companies. Money is just the liquid used to transfer ownership from weak hands to strong hands. That is why, if you only look at your salary or your monthly income and never at what you actually own, you will always feel like you're making progress, while in reality, you're mostly helping the system rotate its cash flow. Meanwhile, those who understand the game use each wave of cash to quietly accumulate assets, and then stand still while the rest of society works hard to keep paying for those assets. At some point, you realize there are really only two types of people in this world: those who work for money and those who use money, debt, and cycles to make other people work for them. Many people believe the highest form of power lies in presidents, prime ministers, or elected governments, but that's only the surface. The reality is that the faces you see on television are public actors, while the real decisions about money, credit, assets, and economic direction are shaped by power groups operating behind the scenes, financial dynasties, global banking families, and institutions that have controlled the flow of capital across generations. They don't need public attention because their influence doesn't depend on votes. It depends on owning what every government relies on: the banking system, the debt markets, energy, food supply, media, and the ability to create credit. Governments change every few years, but these groups do not. They are permanent, stable, and constantly shaping policies through central banks, financial treaties, interest rate decisions, and trillion-dollar investment networks. When a head of state takes office, they receive briefings from advisors, central bankers, and financial institutions, all of which operate under the influence of these deeper power structures. A president can change, but the machinery that controls money cannot be replaced, nor can the elite networks that have been embedded in global finance for centuries. These families and institutions do not need to stand in the spotlight. They influence by deciding who gets access to capital, who gets bailed out, who is allowed to fail, and which countries will suffer when the economic cycle turns. In the global picture, real power isn't held by those who hold microphones, but by those who control the flow of money, the ones capable of speeding up or slowing down the world economy with a single decision on interest rates or credit supply. And here is the truth most people never see. The shadows behind governments are the one controlling the financial destiny of billions. To understand why the global economy constantly moves through cycles of expansion and collapse, you only need to look at 5 core forces, the same 5 levers every government, central bank, and financial institution uses to steer the market: public debt, taxes, inflation, interest rates, and credit. These 5 pillars act like control switches over the wealth of billions. When public debt rises, governments must print more money, borrow more, or raise taxes, turning ordinary citizens into involuntary contributors through inflation and hidden taxation embedded in every product they buy. When taxes increase, workers and small businesses take the hit, while those with power, able to relocate profits or optimize tax strategies, remain largely untouched. When inflation grows, prices soar and asset values jump, but wages never keep up. Those who own assets benefit, while those who rely on salaries slowly lose purchasing power. When interest rates shift, entire financial flows reverse. Low rates encourage borrowing, spending, and bubbles. High rates freeze markets, destroy weak borrowers, and force assets into the hands of those holding cash. And credit, this is the sharpest weapon of all. Loosen credit and an economy instantly inflates with confidence and debt-fueled spending. Tighten credit and everything collapses because almost every sector depends on borrowed money. When these 5 forces move together, they create a closed loop: expand credit, inflate prices, raise interest, trigger recession, buy distressed assets, start again. Ordinary people only see the symptoms: rising prices, sudden crises, fragile recoveries. But those behind the curtain see timing: when to unload, when to accumulate. And if you don't understand these 5 pillars, you will always be on the receiving end of the system rather than the controlling end, standing beneath the wheels of a machine no one ever taught you how to read. The sheep-shearing cycle isn't a single event. It's a recurring global pattern in which asset prices rise, ordinary people take on debt, the bubble expands, then bursts. And the ones who suffer most are those simply trying to hold on to their home or small savings. The cycle begins with the phase of lowering interest rates, where credit becomes cheap and widely available. Low borrowing costs encourage people and businesses to believe it's the perfect time to buy homes, start companies, or invest. As cheap money floods the market, asset prices climb rapidly. Media, analysts, and financial institutions amplify the optimism, making people believe the growth is natural and will last forever. This moves the cycle into the inflation phase, where prices of everything, land, apartments, stocks, rise far faster than the real economy. Then comes the phase no one expects, tightening. Interest rates rise, credit contracts and liquidity dries up. Highly leveraged businesses begin to struggle, households fail to keep up with mortgage payments, and those who join the market last are hit the hardest. The bubble starts to deflate, panic spreads, and assets begin to fall apart. People sell in desperation to repay debt, small companies collapse, and prices plunge to levels where only those with cash or strong capital reserves can buy. This is when the accumulation phase quietly unfolds. Those with liquidity or privileged access to cheap capital step in to acquire homes, companies, and financial assets for a fraction of their peak value. When the economy recovers, asset prices rise again, and the entire recovery belongs to those who bought at the bottom. With just one cycle, wealth moves from the weakest hands to the strongest. This loop isn't new, it's built into the architecture of global economics. And if you don't understand how it works, you'll almost always be the one entering late, paying the highest price at the top, and losing everything when the market collapses. If you want the clearest example of how wealth moves from the many to the few, you only need to look at real estate. Over the past 2 decades, housing prices in most countries have multiplied, while average wages have barely kept pace with inflation. This widening gap separates those who own assets from those who only earn income. When property prices rise, asset owners watch their wealth grow with inflation and market speculation, while workers see home ownership slip further out of reach. Prices don't rise because land is disappearing. They rise because money is poured into the market through cheap credit, speculation, and constantly inflated expectations. When credit is loose, people borrow to buy homes. When prices rise, they rush to buy before it becomes unaffordable next year, taking on decades of debt that quietly transforms their future labor into collateral for the financial system. But when the cycle turns, interest rates rise, credit tightens, and the economy slows, borrowers feel the weight of debt they once believed was an opportunity. Those who bought at the peak suffer first: higher interest payments, falling or stagnant property values, and wages that don't keep up. Many are forced to sell quickly, accept losses, or risk foreclosure. This is when assets fall into the hands of those with capital, individuals, and institutions who stayed patient throughout the boom. They acquire houses, land, and development projects at a fraction of bubble prices. When the economy recovers, prices rise again, and the entire rebound flows back into the pockets of those who bought at the bottom. Each cycle functions like a systematic shearing. Indebted households lose assets due to shifts in interest rates and market conditions, while those with liquidity expand their ownership. Real estate becomes the perfect machine because it has all the needed traits: high value, usable as collateral, easy to inflate through credit, and most importantly, it is a basic necessity, forcing people into the game even if they don't understand the rules. Real estate keeps rising not because land is disappearing or because economies grow endlessly, but because it is the safest container for money in every phase of the economic cycle. When currencies are printed aggressively, when inflation spikes, or when markets become chaotic, those with capital look for a place to preserve value when fronted not to perish. And real estate becomes the perfect inflation shelter. Property can't be printed like money, can't crash overnight like stocks, and doesn't fluctuate minute to minute like financial markets. This makes it the natural destination for major capital flows from governments, banks, corporations, funds, and even ordinary savers seeking protection. Another reason is the way property prices are deliberately lifted through credit expansion. When banks loosen lending and lower interest rates, cheap money floods the market, pushing real estate prices up, not because real demand increases, but because more capital is competing for the same assets. Each wave of credit expansion creates a new surge in housing prices, and households, fearing that prices will rise even further, rush to buy, reinforcing the momentum. Real estate is also the primary tool used by financial institutions to defend wealth against inflation. When costs rise across the economy, housing prices almost always rise with or even ahead of inflation, leaving non-owners further and further behind. While wages grow slowly, property prices grow at the speed of capital injection, widening the gap between asset owners and wage earners. The truth is that real estate prices are not driven by natural supply-demand forces alone, they are driven by incentives. Governments benefit from high land values through taxes, banks benefit by increasing collateral values, and investors benefit from appreciating assets. When all major forces push in the same direction, real estate becomes nearly impossible to suppress in the long run, even during economic downturns. For this reason, real estate is one of the most powerful mechanisms for transferring wealth from those without capital to those who control large pools of money. If you don't understand why property keeps rising, you'll always end up chasing an asset the system never intended you to catch easily. To influence the wealth of millions without ever dealing with individuals directly, governments and central banks rely on just three tools: monetary policy, fiscal policy, and the control of exchange rates and foreign reserves. These three levers function like interconnected gears in a massive machine. Turn one, and the entire economy shifts in the desired direction. When they want asset prices to rise, when they want households to borrow and businesses to expand, they lower interest rates, inject liquidity, and loosen credit. A single decision from a central bank can trigger a nationwide buying frenzy. People rush to purchase homes, companies take on new loans, stock markets surge, and land prices skyrocket to levels that lock an entire generation out of home ownership. On the other hand, when they want to cool inflation or reverse previous expansions, they raise interest rates and tighten credit. Within months, everything from real estate to small businesses begins to shake. Borrowers struggle to pay debts, companies run out of cash flow, and asset prices stagnate or fall sharply. In this stage, those in debt suffer most, while those holding cash or capital reserves benefit. Fiscal policy, taxes, subsidies, government spending adds another powerful layer. By adjusting property taxes, income taxes, corporate taxes, or releasing stimulus packages, governments can redirect national cash flow in whichever direction they choose. But the most invisible and arguably the most powerful lever is the management of exchange rate, gold, and foreign currency flows. When a country devalues its currency, all assets priced in foreign terms rise instantly, while citizen savings quietly lose purchasing power. When they tighten or loosen controls on foreign exchange or gold markets, capital shifts rapidly in ways ordinary people can never anticipate. Together, these three tools create a simple but harsh truth. Most asset movements are not the result of free market forces, but of decisions made at levels ordinary citizens will never have access to. And while you're busy wondering why housing prices rise, why your currency weakens, or why businesses fail, those who operate these tools already know what's coming and have positioned themselves to benefit long before anyone else realizes what happened. The global economic cycle moves like the breathing rhythm of a giant organism, expanding, contracting, and expanding again. It isn't random, and it can't be stopped. It repeats through four familiar phases that nearly every nation undergoes: recovery, expansion, slowdown, and crisis reset. Recovery begins after markets collapse and asset prices hit bottom. Governments and central banks flood the system with liquidity, cut interest rates, and stimulate lending, jobs, and spending, creating the illusion that stability has returned. As confidence spreads, the cycle shifts into strong expansion. GDP rises, inflation stays manageable, households borrow to buy homes and cars, and businesses scale up. This is when bubbles silently form, not because people are foolish, but because cheap credit convinces everyone that prices will keep rising. But when the economy overheats, the slowdown phase begins. Interest rates climb, borrowing becomes expensive, highly leveraged companies struggle, mortgage payments become heavier, and economic activity starts to cool. Businesses cut jobs, borrowers fall behind, and optimism fades. Eventually, pressure builds to the point where the cycle enters crisis. Reset, bubbles burst, Asset prices plunge, weak companies fail, families sell assets under distress, and the economy enters chaos. Yet, in this chaos, the strongest players quietly accumulate everything of value. When prices peaked, they had already exited. When prices collapse, they are the first to buy. This is why they emerge richer after every crisis. From there, the cycle returns to recovery as if the economic clock has been reset and the game begins again. The most crucial truth many people overlook is this: the economic cycle itself is not your enemy. Your lack of understanding of the cycle is. If you don't know which phase you're in, you are likely to buy at the top and sell at the bottom, exactly as millions have done for decades. Those who understand the cycle don't need to predict the future. They only need to know what comes after the current phase. And with that knowledge, they position themselves to benefit every time the next rotation begins. When you look back at everything from asset bubbles and sudden rate hikes to families losing homes, companies collapsing, and powerful players quietly buying at the bottom, you realize the world doesn't run on luck. It runs on cycle. And those cycles divide people into two groups: those who are swept away and those who position themselves to benefit. If you don't understand the cycle, you will buy when the market is euphoric and sell when the market is panicking. You will believe rising prices are normal and falling prices are unexpected. You will think you failed financially, when in truth, you simply moved at the wrong moment, just like millions of others in every economic loop. But if you understand the cycle, everything looks different. You see that expansions don't last forever. You recognize the signs of a bubble inflating. You know when to step aside, when to step in, when to hold cash, and when to accumulate assets. You don't need to predict the future. You only need to know that history never stops repeating. The recovery, expansion, slowdown, crisis pattern is not a secret, it is a rule. The secret is that most people never learn to see it. That's why they work for decades, save carefully, and lose everything in a single downturn. Meanwhile, those who understand the game simply wait for the moment when the market is weakest, because that is when they become strongest. The difference between these two groups has nothing to do with intelligence or privilege. It comes down to one thing: one person knows where the cycle is, the other doesn't. And in the end, the question isn't when will the next cycle come? The real question is, when it does come, which side will you be on? The side being sheared or the side harvesting?